Today on Forbes, calming advice for a chaotic stock market. While the last 3 weeks have been punishing for the stock market, veteran wealth managers are sounding a similar refrain for long-term investors. Don't panic. It can be difficult advice to heed when alarming headlines are regularly flooding the news. 2 days after the S&P 500 index hit its all-time high on February 19th, hedge fund billionaire Steve Cohen made a prescient prediction that he wouldn't be surprised to see a, quote, significant correction in the stock market, calling tariffs an additional tax. On Tuesday this past week, JP Morgan economists raised their recession risk forecast for this year to 40% from 30%. The S&P 500 is down 9% from its high and seems destined to fall further. But history suggests changes in sentiment often happen much faster than investors expect. Just last year, when stocks fell 8.5% over 3 weeks in July and August, those losses were erased within a month. The same is true of the S&P 500's last 10% correction, which took place from July to October 2023. In fact, David Donabedian, co-chief investment officer of CIBC Private Wealth US, which manages $84 billion in assets, says his firm researched, quote, true crises far more consequential than the current self-inflicted declines fueled by tariffs, shocks to the system like outbreaks of war, or the onset of COVID-19. Donabedian says, quote, what you find is that about 2/3 of the time, the S&P 500 has recovered all that it lost after the shock in a month. The punchline is don't do knee-jerk selling, and we've certainly had some of those conversations in the last week or so. The primary culprit for the current stock market swoon is the uncertainty caused by President Donald Trump's imposition of tariffs on imports from China, Canada, and Mexico. Trump initially announced the tariffs over the weekend prior to February 3rd, but when the market opened that day down 2%, he changed course and granted Mexico and Canada a temporary 30-day reprieve following concessions they made to secure their borders with the U.S. Stocks quickly rebounded. That pause expired with Trump allowing the tariffs to take effect on March 4th, but he soon carved out exemptions for some goods subject to a trade agreement he signed during his first term. Since then, investors have become increasingly dismayed at Trump's uncharacteristic indifference to the stock market. Last Thursday, he told reporters he's, quote, not even looking at the market. This week, he walked back a threat to hike tariffs on Canadian steel and aluminum imports to 50%, but added a 25% charge on those metals shipped from any foreign country, leading to retaliatory tariffs imposed by the European Union on U.S. imports. The whipsawing is only adding to investors' uneasiness. Adrian Helfert, Chief Investment Officer for Alternative and Multi-Asset Portfolios at Westwood, says, quote, we knew tariffs were negative for economies, but it's less the impact of the tariffs themselves than the uncertainty of the policy. Small and mid-sized businesses need to know what to expect so they can plan their capital expenditures. Uncertainty leads to businesses that are nervous to plan for a future that they don't know. Jim Baird, Chief Investment Officer at Plant Moran Financial Advisors, says, quote, for your average retail investor, the temptation is to say, I've got to do something during times like this, when the reality is, if you're a long-term investor, often your best decision is to stay out of your own way. For full coverage, check out Hank Tucker's piece on Forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.